Welcome back to Daily Forex Investing News, your go-to channel for the latest updates and insights on the financial markets. I'm your host, and today we have an intriguing topic to discuss. As the drama unfolds in Washington over the debt ceiling, interesting market dynamics are at play. While most investors expect an 11th-hour deal to be reached, let's take a closer look at what's happening. First off, we're seeing some AAA corporate bonds from tech giant Microsoft, Nasdaq, MSFT, and healthcare conglomerate Johnson & Johnson, NYSE, change, trading at a yield discount to Treasury bills. Treasury bills are typically considered the safest investment in the world. This unusual occurrence indicates that investors are willing to take on corporate bond risk rather than investing in government bonds. In fact, Wall Street recently witnessed the busiest week of the year for investment-grade corporate bond issuance. This surge was partly fueled by a massive $31 billion debt sale by pharmaceutical company Pfizer, NYSE, PFE, making it the fourth-largest debt sale on record. The market is certainly active, and it's an interesting development to keep an eye on. Now, let's dive into the current state of negotiations on the debt limit plan. Following a talk on Monday evening, President Biden and House Speaker Kevin McCarthy agreed to continue negotiating to avoid default. However, they did not reach any agreement during their discussions. Despite this, McCarthy expressed optimism, stating, "I believe we can still get there." It's worth noting that he is not considering the president's suggestion to increase taxes for the wealthy or close tax loopholes for the pharmaceutical and oil industries. Instead, McCarthy is focused on reducing spending in the FY 2024 federal budget, following a reported agreement to cut unspent pandemic funding. Although the chances of a default occurring are very small, they are not zero. Analysts and experts have weighed in on the probabilities. According to a new article on Seeking Alpha by John Mason, the chance of default is very, very small, but not zero. This sentiment is echoed by SAW analyst David Lerner, who suggests that this scare could be the last best chance to enter the market rally. On the other hand, Mott Capital Management, an investing group leader, raises concerns that a deal could lead to a significant liquidity drain in the stock market. So, what would happen if the U.S. were to default? Moody's Analytics provides some insights. They forecast spiking interest rates and plunging equity prices. Additionally, short-term funding could freeze up, causing volatility to ripple through the financial system. This volatility could then spread to derivative and mortgage markets, where treasuries are commonly used as collateral for securing trades and loans. The focus would inevitably shift to the Federal Reserve and the options they have to avert a potential calamity. However, Chair Jay Powell has repeatedly warned that no one should assume the Fed can protect the economy. The situation is certainly complex and could have far-reaching consequences. As investors, it's crucial to stay informed and monitor the developments closely. We'll continue to provide updates on the negotiations and their impact on the markets. That's it for today's episode of Daily Forex Investing News. Thank you for joining us, and remember to stay tuned for more insightful discussions. Until next time, happy investing.